Following on the formation of the Government of National Unity, we have seen renewed interest in South African assets in general and equities in particular. But are all local equities created equally? Joining me today to discuss PSG Asset Management's view on local markets is Fund Manager Mikhail Motala. So Mikhail, to kick us off, we've seen something of a revolution in the positioning of many local managers when it comes to their view on local equities. But what does PSG Asset Management think people should be aware of when approaching investment in local assets at this time?
Hi, Audrey. Yeah, so since the elections, we've seen a rally in equity markets and particularly in the JSE. And that's been quite widespread. But the rally particularly has been focused on what we call SA Inc. shares. These are shares that are somewhat exposed to South African GDP. And if we think as to why that's happened, at the heart of the Government of National Unity, at the heart of their agenda, they've put economic growth. And economic growth has a number of knock-on consequences, one of which buoys the earnings of companies, and hence we've seen that with the prospect of future economic growth, companies' share prices have increased. The important bit to understand, though, is it's not just because of the prospect of future economic growth that we've seen this bounce in shares. There's also been tangible lived improvements in our lives as South African citizens. I mean, if we cast our mind back more than a year ago, we were on the cusp of devastating load shedding. It's now been more than 200 days of no load shedding. So there's been a number of tangible impacts as well. And coming to the question on what should investors then think about with regards to positioning on the JSE? Positioning will follow prices ultimately. And when you do see that you have these share prices that have reacted positively to the formation of the Government of National Unity, it's important to have exposure to those shares.
So what sets PSG Asset Management's approach to investing in local shares apart?
So as I said, the JSE itself is constructed of a few different segments. And if we just look at it at a high level, only around 50%, so call it half of the JSE, is exposed to SA Inc. shares. The other half is roughly equally split between mining companies or resources and then the non-resources rand hedges. So from a top-down point of view, only half of the JSE is exposed to SA Inc. Our portfolios, if we look at the PSG SA Equity Fund as an example, has more than 2/3 of the fund exposed to SA Inc. So number one, what sets us apart is we have the exposure to SA Inc. that not all managers do. The second element that sets us apart is we find many peer portfolios concentrated in the banks and the clothing retailers. And whilst we do have exposure to those sectors too, we have highly differentiated SA Inc. positioning. In fact, if you look at our positioning outside those sectors, it constitutes roughly half the fund and less than 20% of the index, to give you a feel. And then finally, when we look into our SA Inc. positioning, it's crucial to note that in order to build SA Inc. positioning, one can't scramble as prices start to rise and buy these shares. They are best bought in times of distress. And that's been a key hallmark of our investment process, has been that we've been able to look through the times of distress and build that adequate positioning well ahead of the advent of the Government of National Unity.
So given the run-up we've seen in South African shares, do you think markets have repriced fully, or do you think there's still opportunities left for investors in the South African equity segment?
So I'll start off by a very inside view, and that's with the companies that we analyze and that we hold in our portfolio, and then I'll zoom out from there. So starting with that inside view, we look at the rally that we've seen on a number of our portfolio holdings. And what we've actually just seen is a bit of a valuation uplift from crisis levels still to a discount to sort of average levels. So whilst they're no longer at their bottom, they are certainly not at the top in terms of a valuation range. Crucially, however, for many of these companies, earnings are still low. So as those earnings come through to fruition, or that growth comes to fruition, we should see share prices continue to perform. Then zooming out one level, we look at equity flows into the JSE as a whole. So foreign flows are tracked on the market, and foreign flows are still ticking at sort of negative 120 billion rand by foreigners. Foreigners have been net sellers of our equities. They have not been net buyers of our equities. So foreign shareholders buying our equities would boost the rally further. And then zooming out another level, we look to emerging markets as a whole that have been largely out of favor relative to the US stock market in particular over the last decade and a bit. And with emerging markets, there are signs of it becoming more in favor. And hence, South Africa as an emerging market would stand to benefit as well.
So can you give an idea of how you are positioning portfolios to take advantage of the opportunities that you are still seeing in the market?
Yeah, so the top holding across a number of our portfolios is Discovery. Discovery Limited, listed on the JSE. It's north of 100 billion rand company, and it's a real entrepreneurial success story of corporate South Africa. It was built from scratch and has grown organically over the past 30 years. Discovery trades on 13 times earnings, but in their most recent results presentation, they've sketched out their forecast of growth in profits to be between 15 and 20% per annum. So for a 100 billion rand company that's growing north of 15% per annum, that's available at the 13 times price to earnings multiple, it's a very attractive opportunity for us. And then to give you one other example, we look at our holding in the construction companies. I referenced that to buy these shares, one should buy them during times of distress. And if we rewind the clock back to 2018, by some accounts, when we read the annual reports of construction companies over that time, it's been noted that 2018 was the darkest period in the construction industry's history. They were incredibly troubling times for the industry. Now, we were buying those shares not despite of those dark times, but actually because of it. And the reason is because during those times, the valuation multiples that these companies traded on were very attractive. In fact, they were at crisis levels. And secondly, what the tough times meant is that unfortunately, some construction companies ultimately failed and went out of business. And the survivors who were left behind just had a much more stronger competitive positioning to benefit from any uptick that comes through in demand. And as such, we were able to build positions in a number of construction companies, and they've been good performers to date and still are very well poised to deliver good performance into the future.
Mikhail, thank you so much for joining me today and helping us understand where those opportunities in the South African markets can still be found.
Thanks, Audrey.